excitement is different from the opportunity evaluation as an investment, right? I might get excited about a rocket launching startup, but it might not make business sense and might not make sense for me to invest in it, right?
Yeah.
So angels are not able to differentiate that. If they get excited and they invest, I think that's one of the mistakes they do.
Adith, you're the managing partner of Gemba Capital. It does seed stage investments in Indian startups. And I saw some of your portfolio and I was really excited about it because I operate in the personal finance space, in the financial freedom space, and I saw Vint Wealth and some of the others over there, and they're doing some good work, right? It's a good ecosystem. So first, why did you come up with the name? What is Gemba Capital?
Okay, it's very interesting. Actually, Gemba is Japanese for the real place where value gets added. It's a term which I've picked up from Toyota Production System. It's not used in financial services per se, and which actually means, I'll give you an example. Like if there is a crime scene which has happened after a crime, that entire area is called the Gemba, because all your clues and all your solutions and to why that has happened lies in that Gemba, right? So that's what exactly I think is the philosophy which even we want to work with, wherein the answers or solutions to problems don't lie in meeting rooms or with data. You need to go on the shop floor. You need to go at the Gemba and then figure it out, right? So I think that's why we kept our fund name as well as Gemba.
That is very exciting. That is very interesting to know. And I think it's got to do with a little bit about your background as well, where you've been an entrepreneur and an investor in different investment fields, right? Different approaches. So what is your approach at Gemba when you are looking at seed stage investment? What are you looking at? If someone were to come to you, either to say, hey, here's my money, invest in startups on my behalf, or a founder comes to you and says, I want money from you.
Sure.
What is the approach?
Yeah, so I think this is a very, very long answer. I could take 2 hours to answer it, but let me try to summarize it, right? See, there are certain steps which we have when we evaluate a particular transaction, right? And a deal goes through that particular steps, right, in evaluation. And for every fund, this is different, right? For us, the first thing is the founder, and a concept called founder market fit. If listeners want to understand more about founder market fit, they can visit my website, and we've written a blog on that. What essentially we're trying to understand is, are these founders the right set of founders for this kind of a business, right? Do they have complementary skill sets? Do they have the ability to build a product? Do they have the ability to hire the right kind of a people? Do they understand the market? Do they have domain expertise? Is the GTM in place? Do they have a technical co-founder who can build the MVP and handle scale? So there are a lot of questions, whether on the emotional capabilities, on execution abilities, leadership abilities, wherein we put in all together and first try to assess whether the founding team is a go-ahead or no go-ahead. Because that's what is the most important thing at the seed stage, right? And I'll come to it when we used to do private equity, how different it was, right? But at the seed stage, the founders are not proven, right? So that is the first step which we take, whether most of the transactions go negative on this itself. If it goes ahead from the founder, then we go to the market, because the market has to be large, it has to be growing for us to have a large outcome. If the market itself is not large, I can't get a large outcome. And if the market is not large, the other investors will not come in, larger investors who are expecting billion-dollar outcomes. So I again don't get an exit. So we have to look at what are the key growth drivers in the market. Is the profit pool in the market enough? Is there any strong tailwinds to the market, right? And so assessment of the market is important. The founder is done, the market is done. Then we talk about the defensibility. What they are trying to do is there any defensibility in it? Is there any moat around it, right? Is there any network effect happening? And can they kind of have some first mover advantage and things like that? Once that is true, then we talk about growth or traction in simple terms. At seed stage, you don't see much of traction in terms of revenue. So what you look at it is there any some customer love? Is there easy adoption? Are they trying to solve a problem which many people have, right? Those kind of things, whether the market research was done, was it positive? Were the initial pilots and experiments successful enough? Those kind of things, right? And if it's a Series A or a beyond company, obviously you'll have numbers to see that. And finally is the price and the valuation. which actually comes in the end for us,
Right.
right? So this, where are we paying the right price for a product like for a company like this? So once someone goes through this is our approach where we say yes, right? Uh, and come to think of it, if I was a private equity investor, it would be the reverse. Founders have already proven themselves. They already are running a business which is 300, 400 crores, right? Market is already established. Product is already there for everyone to see. So there you talk about first is the valuation, whether they're going to make money or not, and then the reverse, right? Then the traction, and then the market, and then the founders.
That is really, really an awesome comparison between private equity and startup seed
Yeah.
stage investing approach.
Yes.
And how do you look at it? If I'll just share my 2 cents in the way that I have looked at startups, so that our audience gets another point of view
Sure.
or colliding perspectives, right? So I look at founders and I look at what they are doing. Do I like these founders and the space that they are operating in? Would I want to build a business like this, but I don't have the bandwidth because I'm doing something else right now. And so I'll do the next best thing, which is I will support these founders. And here's my money, here's my network. And if you want, here's my guidance.
Correct.
Right? If it helps.
Correct.
So that's an alternate way where I've
Absolutely.
said, you know what, I know how the startup ecosystem works. I've been in this space, as head of operations at GeoGen Next, advisor to Advani Foundation, setting up the Center for Entrepreneurship at Flame University, right? And so I've interacted with about 5,000 odd entrepreneurs. And so now the deal flow is very easy. They reach out to me rather than me reaching out to someone else.
Correct.
And then I'm just evaluating from the parameter saying, do I love these guys or not?
Yeah.
And are they passionate about it?
Yeah.
Is it a problem worth solving? Top mistakes that people make when they are investing in startups.
If I talk from angel investors' perspective, I think the first mistake they do is they get excited by the idea, and excitement is different from the opportunity evaluation as an investment, right? I might get excited about a rocket launching startup, but it might not make business sense and might not make sense for me to invest in it, right?
Yeah.
So angels are not able to differentiate that. If they get excited and they invest, I think that's one of the mistakes they do. Second is they don't go deeper in the business, and rightly so. They are angels. They have other businesses, so they can't spend that kind of a time. But honestly, it's your money, and you should be spending some more time on it. So they don't evaluate the second layer or the third layer and go deeper into the business. It's more of sometimes one call and saying a yes, without having a thesis and understanding of the market, right? And third thing I feel is signaling bias. Oh, my friend is investing. Oh, this VC is investing in this round. Oh, this guy respect is investing. Let me also put my money. Oh, you've understood now. I will also put along with you. It doesn't work like that. It's just as good as gambling, or you're relying on someone else. But that's not the right way to do it, because you will not develop that skill yourself, right? And last is making too few investments and then stopping. Like you've done 5 investments, you don't see it going anywhere. 4 of them have not made money, and you said, "Was this not an asset class for me? I'm not investing anymore." That's the biggest mistake, because the 6th one could have been a multi-bagger. So that's why I say that you start when you know that you can do 25 to 30. Otherwise, don't start, because you will end up stopping in between and losing all the money.
Yeah, I think the last point is really important. I'll build on it with a couple of mistakes that I have seen. I've seen a few people invest saying, I can actually get these guys to work, the founders, and drive their direction of where they are going, and then make sure that I can, get an exit to them as well. So I thought that is one of the biggest mistakes to make at the seed stage, because you don't want to be driving the company yourself. You're an investor. Stay an investor. You can be a board of director or a board of advisor, and you can put some governance rules around it. But I see as Shark Tank is becoming more popular, more people from traditional businesses, say real estate, say manufacturing, as they look at it, they are used to a complete control over where the money is going, right? And whatever money they put in. And so those investments are significantly different from startup investments. And I think that's an important point to talk when we are talking about maturity of the Indian ecosystem.
Yes, it will still take time, and I completely hear you. A lot of the traditional, investors used to appoint their own CFOs, so that we know that where the cash is going and how it's getting managed. things have moved on from there, right? The best founders are the ones where they don't need your inputs or they don't need your value and they're going to
Just
run the
give the
show.
money.
Just give the money. You're an investor, right? And if you don't trust them, don't give the money. As simple as that. But to think that we'll be able to add value, sure you can add value. You can open up your network, but when you're thinking about 30 companies and this is not your full-time job, how are you going to add value, right? So you would want to have investments in companies where they don't need you.